Welcome to Oregon Cash Flow Pro. My name is James Barber. Today we're going to be talking about premium financing. If you are in the market for premium financing or you know somebody who is, please share this video. You could potentially save them hundreds of thousands of dollars in expenses. They will likely thank you for it. I'm going to show you a real life example that we encountered last week, the problems that we identified with the design and the plan, and then of course our solution to it. And I bring you all of this at the low cost of $0. So do me a favor, hit that like button, subscribe to the channel if you're interested in following along and learning more about life insurance and how to get the best designs and give you the best chance for success if you decide to utilize one of these products. So a quick summary of what we're going to get into in this video. We're going to talk about premium finance, what it is, potential situations that it might want to be used, things to watch out for. There are definitely some red flags out there, what type of expectations you might have with it, and how we can make it better. I always like to describe it as giving ourselves the highest likelihood of success. There are certain things that we need to do to make sure that we have the highest likelihood of success. You're going to learn what those are in this video. So let's get into it. Premium financing is a situation where somebody might not have enough liquid cash to purchase the policy that they will and fund it in a way that they would like to fund it because they've got their assets tied up. They're illiquid. And so they're going to use a lot less of their cash and the assistance of a premium financing company in order to help fund the rest of the policy, otherwise known as using leverage. So they're going to use some of their money. Sometimes it could be 50-50 split. It could be a 4-to-1 split where the client puts up 20% and the premium finance company puts up 80%. I've also seen higher ratios than that. But at its base level, what we're talking about is using another company to provide some leverage so that you can get potentially better returns. Now, the more leverage that the premium finance company provides, the greater the collateral requirement that you might have to bring to the table outside of the cash value that's growing inside the product itself. Those two are directly related. The more cash value that grows inside of the product, the less collateral that you'll need to supplement, as long as the premium finance company can be made whole if that policy were to lapse. There are some premium finance companies out there that only use the policy itself as the collateral. As far as I'm aware, those are the companies that have that 50-50 ratio where you're putting up half and they'll put up half. Most plans look similar to what you see right here. You've got a certain amount of funding coming in. After a number of years, in this case 13 years, the premium finance company gets paid back. And then a few years later, the client gets to start an income stream for the rest of their lives. And this is the appeal to this type of design. In this case, the client was going to put in $50,000 for 10 years, each year for 10 years. And the premium finance company was going to kick in $200,000. So you get a total of $2.5 million, goes in over 10 years. Remember, the client puts in 50, and then when they go to retire, they're going to pull out nearly $200,000 a year. That sounds pretty attractive, doesn't it? And for a lot of people, that's the selling point on this. They don't quite understand everything that's going on inside of it or how they're getting to those numbers. It's oftentimes not clearly explained, but it can come with very large expenses. And that's what we want to be aware of. We want to be aware of what's the risk in this thing. Well, in this scenario, the premium finance company is going to charge 6.5% in the first year. That number could go up or down depending on where the interest rate environment is and what that rate is actually tied to. A few years ago, premium financing was a lot more attractive. Rates were down in the 2.5-3% range. And then the interest rate environment went up and all of the premium finance loans, the rates skyrocketed. Additional collateral was required in those scenarios. And for a lot of people, that coincided with a drop in the market. So not only was their collateral requirement going up, but the performance in the policy was not attractive in those years either. Certainly not matching what the illustrations were showing. Now, in general, in the IULs, we don't worry too much what happens in any given year, as long as on average we're doing good for the rate of return and we're earning some positive arbitrage. Because the key to these premium financing is to get arbitrage where we're earning more than we're paying on the interest. That's one of the keys to these illustration designs. The illustrations are going to assume 0.5% arbitrage above whatever the cost is to borrow. So when you see an illustration for premium financing, the higher the numbers are, the more money you borrow, the better the return later on, the more money you're going to be able to pull out later on. Will that actually play out that way? Maybe. Depends on how the index actually performs and if we do get that arbitrage. But we just got to be aware of the assumptions that are being made inside of these. So in this scenario, again, the client put in $50,000 a year. The premium financing company kicked in $200,000 a year. You can see our cash growth happening over here. The loan is outside of the insurance company until year 13. And in year 13, they're assuming the rate stayed the same at 6.5%. The loan company gets paid off here. And now we have a loan inside the policy. And so there's still cash value above and beyond what was borrowed. At this point, the clients kicked in $250,000 of their own dollars, and there's $686,000 in there by year 13. And we're going to continue to see growth inside of this because we're assuming some arbitrage on all of those collateralized funds, as well as growth inside on the non-collateralized funds. And then the loans start to come out. Now, we always want to take a look at what are the rest of the assumptions that are happening inside of this, and what is the likelihood that this is how it's going to play out. If you follow my channel at all, you know I like to be a little more conservative when it comes to what is the rates that we're going to illustrate on these things. This is the assumptions made on this policy. 6.72, this is the maximum illustrated rate that they could do in the illustration at this time. It doesn't really matter what index options that you're choosing. There's a maximum rate that can be illustrated, and they chose to use the maximum rate. This is not something I like to do. I like to dial it down to 6%. I think 6% is a reasonable assumption that we're going to be able to beat the market. We have a very good chance to outperform the illustration if we're illustrating it at 6%. It's certainly possible we could outperform it at 6.72 as well. But let's bring those expectations down a little bit. We don't need to make all the rosiest assumptions just to sell the product. And I'm going to show you, and you're going to see when we do a better design, that we don't have to use the maximum assumptions for this thing to do well. We can see that this is a $3.85 million death benefit, and we've got a planned premium, $250,000. So this matches what I just showed you on the last screen. Now, the reason this ended up in front of us last week is because the client was looking at the illustration and saw that there was a lot of expenses inside of this thing. And so they wanted to do some more research. Additionally, the agent that originally designed this policy designed it with a small blend of supplemental term rider. And the client, doing their due diligence, read the description and saw that it could be blended up to 10 times. This was not blended up to 10 times. It had a very small blend. We had $3 million in base face amount and $850,000 in supplemental term insurance. So the client reached out and said, hey, what does this look like if you actually do a blend up to the 10 times? And the agent didn't want to do that. They said, we don't do that. That was when this person got online, found me on YouTube, saw my videos, and realized, oh, I need to talk to somebody that knows what they're talking about and figure out this information that I'm missing. Not everybody is going to do that. In fact, a very small number of people will probably take that next step. I think oftentimes premium financing happens and the thought is they're using other people's money. There's going to be a cost to that, and the expenses might look high, but that's just going to be the cost to do this. They don't know that there's a better way to do it. They don't know that we can reduce the expenses and give this thing a lot higher likelihood of success. Here's what these expenses looked like. We've got total policy charges each year, which are pretty high. You've got your load fees, policy documentation fee, the per unit charge. This is where they're going to recoup the commissions. Not just the commissions, but any other expenses associated with selling the policy. Then you have your cost of insurance, which is actually this column and this column. You just add those two together. When we do a blend with the supplemental term, the supplemental term is what gets put into the rider charges column. There could be some other riders that have an expense. There isn't in this case. So the only expense that we see in the rider charges column is the cost of that supplemental term insurance. Now, as you can see, the major expense is right here. Over the course of 15 years, the carrier is going to recoup $199,000 in expenses. Now, the reason for that is because the target premium on this policy is $72,000. Target premium is kind of a misnomer. A lot of people think that you have a goal for how you want to fund something, and to reach the goal, you're going to aim for a target. And that's often how target premium gets treated. If you want to put in that much money, that's what target premium ends up being. In reality, target premium has little to do with how much you plan on funding a policy. Remember, in this scenario, the client's going to put in $50,000, and the premium finance company is going to put in $200,000. Well, this target premium is a lot less than $250,000. There could be designs where target premium matches what you're trying to put into the policy. But what you need to know is that target premium is how the insurance company knows how much to recoup in expenses. For this carrier, it's over 15 years. So this number directly relates to that $199,000 that they're going to recoup over the next 15 years. From an agent standpoint, agents generally make about 100% of target premium for their first year's commission. So this policy, just as an easy rule of thumb, it's going to be different. It's not going to be exactly that, but just figure the agent's going to make about $72,000, probably a little more than that, in commissions for the first year for selling this policy. Now, every year after, there's a small recurring amount that the agent will get paid based on how much the policy continues to get funded. So the bulk of the expenses are going to be determined by this target premium and how much commission they're going to get in that first year. So if the agent gets $72,000 in commissions and the insurance company has other expenses to pay out, that's why they need to recoup $199,000 over the next 15 years. That's a lot of expenses. You can see we're at $414,000 in expenses by the time we get to year 15, which is nearly 20% of what was paid into the policy. I would venture to guess that this is a very risky design. If you're paying 6.5% cost to borrow on all those leveraged funds, and you're going to get 6.72 in growth, you get a small bit of arbitrage on the borrowed funds, and the growth in this policy, it's not guaranteed. We hope it'll do well, but we don't know what it's going to do. But what we do know for sure will happen is these expenses are going to get charged. The expenses are the one thing that we know is a certainty. So how do we make this better? How do we give ourselves a higher likelihood of success with these products? It's certainly possible that this could play out exactly how it's illustrated, and that the client ends up being able to take out $199,000 every year in retirement. That is definitely a possibility. In illustration, it's not meant to be an exact projection because it's never going to play out exactly how it's illustrated, whether it does better or worse. It just won't happen how it's illustrated. The illustration is good for showing us how these things work. And we can compare illustrations, similar illustrations between carriers to see how they might compare based on the assumptions that we're making. So in general, I like to dial back the assumptions a bit, but also we like to design a better policy that has a lot lower expenses inside of it. And this is where we can really make these things better and give you a much higher likelihood of success. We're going to go back to this slightly different ledger, but remember, we're putting in $250,000 a year. We're going to borrow in year 13, and we have an income that comes out in year 19. These are your cash values minus the surrender charges. The way premium finance works is your collateral is going to be required for the difference between what was paid in and the actual cash value that you could walk away with if this policy were to lapse or close. So in this scenario, in year 2, we can see we've paid in $500,000. The loan to the premium finance company is $400,000 plus a year's of interest. And these are actually end of year numbers, so 2 years of interest. The accumulated value is here in the current value column at $478,000. But we have substantial surrender charges due to the expenses inside this policy. We've got $120,000 in surrender charges. That's the difference between these two numbers. So they're in year 2, $120,000 in surrender charges. So if you were to close the policy, you walk away with $358,000. That is not enough to make the premium finance carrier whole. So in this scenario, you would need a little over $40,000 in collateral at the end of year 2. Now in year 1, you can see there's $125,000 difference here between this and about $100,000 between what was paid in by the premium finance company and that cash surrender value. That's after we get some growth. So prior to the growth at the end of that first year, the premium finance company in this case is going to require $125,000 in collateral. So the client puts in $50,000, they put up $125,000 in additional collateral. The premium finance company kicks in $200,000 and you get your first year's policy performance. So we talked about the things that could go wrong a little bit. Let's just reiterate the things that could go wrong. You're paying 6.5% to borrow from the premium finance company. Those rates could go up. The index could earn no credits. So this $16,000 in assumed growth could actually be zero. Your cost of borrowing can go up. Your credits can go down. Now they could go the other direction as well. That is a possibility, but we always have to worry about what's the worst thing that can happen here. We want to protect ourselves from the downside. We're not just going to assume everything rosy is going to happen, okay? So it's possible we get no credits and it's possible they raise the cost to borrow. That can happen in any given year. And the farther we get into this, the more we're going to rely on those gains to offset all of the expenses on the growing loan to the finance company. Because remember, we've got to pay back potentially $3.2 million by year 13. We're going to need some growth happening to make that happen. So there's the risks. Let's look at how we make this better and increase the likelihood of success. This is the design that I did to match the other one. Still $3.85 million death benefit. We're still getting $250,000 in, and we're still assuming we're going to borrow from the premium finance company. Now, I wanted an apples to apples comparison, so we're still assuming 6.72 on the growth. The only thing that I'm going to change in this scenario is we're going to reduce the expenses with the one thing that I can control, which is the commissions. We can do a better blended design. Remember, the client asked, can you show me that 10-to-1 blend? And they said, no, we don't do that. Well, I do that. I do that because it gives us a much higher likelihood of success. Sure, it's going to cut my commission way, way down. But watch what it does by just making that one change, how it increases the likelihood of success. So you don't have to buy a policy from me to get this. There are agents that will do this. And if you know it's available, you can ask for it. If they won't do it for you, meet with me. I will help you out. This is what I do. This is what I do all day, every day. And when we increase that blended design, this is the immediate impact. That target premium drops from $77,000 down to $8,490. The commission that gets paid to the agent goes from $77,000 or $72,000 down to $8,000. That is a significant impact. Let's see what that does to our cash value. You can see here in year 1, the difference between these two, remember, is our surrender charge. Instead of $125,000 in surrender charge, we've only got $15,000 in surrender charges. That gives us a significant boost in actual cash value inside the policy. In this scenario, you've put in $50,000, the premium finance company put in $200,000, and your surrender value is over $200,000. How much collateral do you need? 0. You don't need any collateral in that case. The policy can provide all of the collateral. We're still going to assume we're paying this off. Now, I did the same death benefit, which means I can't quite put in as much money. When we do the blended design, the max you can fund it at goes down slightly. So we're not quite getting in $2.5 million over 10 years. We're $33,000 less, but we're still able to pay off the loan in year 13. You can see the payout goes to $243,000 every year in retirement. By me reducing the agent commission from $72,000 down to $8,000, the potential income jumped from 190,000 to 243,000 every year in retirement, which is, in this case, the assumption is almost 60 years of payouts. That is a significant difference. Now, you don't have to take out that much. It may not even be possible for you to do that, to pull out that much. Remember, the actual results are going to be based on what the real results of the index growth are and the projections that we're going to make at that time. This is just one possibility that could potentially happen. Let's look at the expenses. This is the policy charges ledger on the optimally designed policy that reduces the agent commission. You can see we're still putting in $250,000. The load fees stayed exactly the same, except for where we're putting in less money. The documentation fee stayed the same, but the per unit charge, this was over $13,000 a year in the other scenario. There's the other one, remember? We had $199,000 in total charges where they're going to recoup from the commissions that got paid out. Here on the optimized design, how about a total of $25,000? Remember when I said at the beginning of this video, if you share this with somebody who is looking at premium financing, you could save them hundreds of thousands of dollars. In this case, we're talking nearly $175,000 less in expenses, guaranteed, because of the design. These numbers do not change. There is no fluctuation here. This is strictly based on what that target premium was when the policy was sold. Now, it just so happens that our cost of insurance is actually less expensive as well. Remember, we add these two columns together. So we have a total cost in the first year right at $2,000 for the cost of insurance. Here in the original design, nearly $6,000 that first year. Total policy charges that first year, $41,600 in the poorly designed one, $26,000 in the well-designed one. It's not magic, folks. The lower the expenses that we have in the policy, the higher the likelihood of success, because more of your dollars are going to turn into cash inside the policy instead of cash in my pocket or cash in somebody else's pocket. Now remember, in that scenario, we're still using the premium finance company. We're still assuming a 6.5% rate to borrow that remains steady, and we were still assuming that you had to pay off a $3.2 million loan in year 13. To get out from under that premium finance company. Now, one of the things to remember when you're borrowing from a premium finance company is that you don't have access to that cash value while that loan is outstanding. So while there's hundreds of thousands of dollars built up inside the policy that you might otherwise have access to if you weren't using premium financing, you can't touch it in this scenario. That's a trade-off a lot of people are willing to accept in order to get it and take advantage of the leverage provided by the premium finance company. But what if I told you there could be a better way that you don't lose access to that extra funds, just in case you had other things that you needed to do with it or you wanted to do with it? Maybe you had other assets that you were looking to buy. Maybe you had an emergency that you needed access to some of those funds to be able to meet. Let's look at the better way to do it. This is the information on the loans that are available from the insurance company. With this carrier, it's a 5% cost to borrow for the life of the loan. That rate cannot change. That is a participating index loan. You're essentially in the same position as borrowing from the premium finance company in that it doesn't impact the growth. When you borrow with a participating index loan, your index growth is based on your index allocations. So if you earn more than 5%, you get the arbitrage. Remember, borrowing from the premium finance company, right now, you borrow at 6.5%. So if you want to get arbitrage, you got to earn more than 6.5%. If we only have to earn more than 5%, we just increase the likelihood that we're going to earn some arbitrage. Now, there are fixed loans that are available as well. And you can do either one. And in fact, with this carrier, you can do both at the same time. You could have some of your money collateralized with an index loan and some of it collateralized with a fixed loan. And we can have a discussion about which one might be appropriate for your scenario if you end up as one of my clients. But these illustrations, remember, are assuming indexed loans. When we pay off the finance company, we're assuming indexed loans from then on. There are certain risks associated with that, which I've covered in other videos. Please check those out if you're interested in learning a little bit more about that. I generally don't like to assume participating index loans throughout retirement. They can get very risky when the balances get very high. And the balances get very high when we're doing premium financing. So there could be some good scenarios where we might utilize some of these fixed loans, where we always get a credit. So what's a possible alternative to using the premium finance company? Why are you talking about 5% borrowing from the insurance company? With a poorly designed IUL, what I'm going to talk about is not possible. If you have $50,000 to put into the policy and your surrender charge is over $125,000, you're not going to have any cash value available in that policy to borrow from the insurance company. So this doesn't work. If you have a policy design like this, forget about it. It's not possible. Not possible to do something different. You would need to utilize the premium finance company if you wanted to do something like this. However, with a well-designed policy, this opens up some other possibilities. If our surrender charge is $15,000, and if we dump in that $50,000 that we would have put in using the premium finance, in this case, we're not using the premium finance company. We dump in $50,000. That's going to turn into about $30,000 in cash value. That's going to be available to borrow as soon as those funds clear. So I'm going to propose one possible scenario here that we utilize that cash value that we just generated. If we have mech space, if we have space to put in more money, we dump in the 50, we borrow out the 30,000. Now you're sitting on 30,000 in cash. What do you want to do with it? Well, you could choose to send it right back into the policy as new premium. There's going to be a load fee that comes out of it. We've already met the surrender charges. So you dump that 30,000 back in and you could potentially borrow out 27,000 immediately, or somewhere close to 27. Now you have 27,000. You can dump that back in as new premium. Borrow out 24,000. Dump that back in, borrow out 21. And we do that until we get to our MEC limit or we run out of cash. We're still in for 50,000. We've just recycled that cash to hit the MEC limit. And all of those loans that we took out are at that 5% fixed rate. We're not paying 6.5%. And if we leave some cash value in there that we didn't borrow out, that cash value is still accessible to us if we need to borrow it out. Now, you generally don't want to borrow everything out of these things. That creates some risk. If we get a 0 year and we still owe interest, you might have to come up with some extra cash. But in this scenario, you're going to be dumping in 50,000 again the next year anyways. So even if we get a 0 year, that next 50,000 will easily cover the interest. If we borrowed the $200,000 from the insurance company by cycling it back through at 5% interest, that's 10,000 in interest. The 50,000 you put in the next year covers that interest. The cash value is going to go up more than enough to cover that interest for that year and create cash value that you could then recycle back into it. Hopefully I didn't lose you there. It can get a little complicated to do this type of a strategy, but it is possible. I've done this with my policies because I'm the cash flow pro. I rarely sit on a bunch of cash that is not actively working for me, but I have some very large premiums that I can make in my policies. Now, I design these policies where I don't have to make the big premiums, but I can. I have the ability to. And I can just dump that money in throughout the year whenever I get it. Since I don't generally sit on, well, let's take one of my policies as an example. I put in $58,000 a year into my policy. I don't usually sit on $58,000 in cash. I might have $20,000 or $30,000 in the bank at a given time. And when my anniversary rolls around, I'll take that $30,000, I'll dump it in, and then I'll borrow it out and I'll dump it back in until I hit that max of $58,000. And then I just worry about paying the loans back as I have cash that comes through throughout the year. So that's one of the ways that I do this. I've done this. I have experience cycling the money through this. It's not illegal, and it's a good way to ensure that we get a fixed interest rate for the life of the policy, that we don't have to worry about it going up or down. Now, I'm really happy at paying 5% for the rest of my life. I think that's a number we can beat with certain other investments. Even the growth in the policy, I think we can beat that 5%. Not in any given year. We could have 0 years, but we've had some really good years in these things. My personal experience in these policies has been a net arbitrage in every single IUL I've owned. I've had net arbitrage in those policies. So it is a very real possibility. I've experienced it myself. So I'm a believer in this process. And if we design these properly with the low expenses, which gives us the low surrender charges, we have the ability to make these things better. So let's see what the solution is for this particular situation with this client. This is the design we ended up going with. We reduced the death benefit to $2.75 million. We reduced the total premium going in to basically $200,000. It's just over $200,000. I've reduced our assumptions. We're no longer assuming 6.72%. We're going to assume the 6%. This is a lot more in line with what I like to illustrate so that we have a more conservative guess that hopefully we'll be able to beat with actual performance. Target premium on this, $6,000. We have the maximum blend with that death benefit. We have $250,000 base, $2.5 million supplemental term blend. Here's what that projection looks like. We max out, getting in $200,000 for a few years. Our actual MEC limit is $176,000, so it has to reduce a little bit in here. But in total, we're going to get in $1.76 million over 10 years. So we're $800,000 less that we're going to get into this policy over that time period. But we no longer have to pay off a $3.2 million loan in year 13. Instead, we're going to be taking out loans regularly. Now, I can't illustrate loans in the first few years, so we have a lump sum here that we're having come out in loans. But you can see the loans that are going to come out ultimately by year 10, we're at $1.2 million. Significantly less than the 3.2 3 years later that we were assuming had we done the premium financing. We can see in the cash value, our surrender charge is only $10,000 in that first year. Now it goes down a little bit each year until it eventually goes away. Because we started loans, we don't actually notice when it goes away. But it does eventually go away. And the projected income, $195,000. We have a higher projected income in this scenario than we did in the original illustration that had the higher death benefit and $800,000 higher in funding over those first 10 years. Correction, it was just a little bit lower. Projection on the original one was $199,000 a year, and on the one we went with, we're projecting $195,000. But we've put in $800,000 less dollars. Total expenses by year 20 in the original design, $434,000. In the new design, how about $167,000? That's $270,000 less in expenses in 20 years. It's always exciting for me to be able to show you guys what the possibility is with these products when we're optimally designing them. The risks that become associated with them get reduced to a very small risk, but the potential is really, really good. Now, in this particular product, it's been a great year in the stock market. And it's been a great year in the index options in these products. I have clients that are getting upwards of 20% this year with these particular index options that we have available in this product. That's real life. I've got people who are breaking even, meaning they've made more money in their policy than they've paid into it, or they have more cash value in their policy than they've paid into it after 1 and 2 years when we get that type of return. That's just not possible in some of the other popular cash value life insurance products. But the key to that is to have a nice low expense design. So I hope you found this video helpful. If you're in the market for premium finance, check out my Calendly link, sign up for a meeting with me. I'm happy to discuss with you. If you have a current illustration, let's look at it. I can tell you how to make it better. Even if you're not wanting to work with me, if you have another agent that you want to work with, I can show you how to do a better design or help ensure that you're getting the best design with the product that you're looking to get. I'm contracted with dozens of insurance companies. This is not the only product that I sell. It just so happens to be a really good one when it comes to premium finance. A lot of people use it for premium financing. It gives us the ability to do a really strong blend that reduces the expenses, even when we're not doing premium financing. And I own these products myself as well. So I look forward to having a conversation with you folks and helping you out. If you have any questions, you can put them in the comment section below. I'm always answering questions in the comment section. You can schedule a meeting with me if you want a one-on-one consultation, or if you want me to review an illustration or get you a quote. Thank you for joining me today. I really appreciate it. If you made it to the end of this video, leave me a comment below that says self-financing is the way to go. I hope you found value in today's video. If you'd like to find out more about IUL and the whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.